So with that, may I pass to the next session, which is going to be chaired by Mr. Ilias Kanzos. Ilias is the CEO of the National Bank of Greece Securities. In the past, he served as the head of the investment banking in NBG, and he has also held positions with Credit Suisse in Zurich and Deutsche Bank in London. And he's also holding an MBA from the University of Chicago. So, Mr. Kanzos, the floor is yours.
Hi, George. Good afternoon, all. Thank you very much for the invitation. It's an honor to be here. The session is titled Strategies and Performance. And I would like to welcome all three participants. I will start with Elizabeth Buki, if I say correctly the name, right? Okay. And let me say that Elizabeth is the founding partner and CEO of Bear Capital Management, which is an asset owner-driven investment management company specializing in governance for investments and total fund portfolio management. Until 2019, she was the Chief Operating Officer, Investment Officer at CalPERS. And prior to that, she was the Head of Pension Assets and Liabilities at ABB Group. Also, she holds the Independent Non-Executive Director position at various boards. And she holds a master's and bachelor's degree, as well as a PhD in mathematics and financial mathematics from Swiss Federal Institute of Technology. She will present the governance-led investment strategies for pension funds, case studies. So I'll leave this, Elizabeth, to you. And 15 minutes, please. Thank you.
Perfect. Thank you very much, Ilios. I hope everybody can hear me properly, right? I'm very super. Very good. I'm very happy and honored to be there. Thank you very much for the invitation. So what I would like to share with you, and I've prepared a couple of slides. I will share my screen if that's okay. Do you see it? Do you see my screen? Sorry. Yes, here you go. And I guess like this. Is that the proper way to do it? Yeah. Very good. The idea is for me to kind of share with you a bit of my experience with governance and governance when it comes directly to the investments. I very much liked the question of Artemis just before in the last session, where she asked the very difficult question to Chris, right? About, yeah, but what about the governance? So when it comes to share my experience about pensions and running pensions, right? Every single thing always boils down to governance, right? And it was really my experience at ABB or at CalPERS. There are so many different pensions, either put together or scattered, that have their own, I would say, culture and values, and at the same time that they have their own structure between board of trustees, investment committees, investment office. And the big question is really, how do you make these organizations work together, right? As such. So it's not governance in the terms of compliance or regulatory rule only. It's really about how do you do to have an effective decision-making mechanism, and how do you have more than that, a collective effective decision-making process around the lines. So if we go down a pension organization, very quickly you have a first layer of your own organization governance and your values and your culture, right? Which is very different from one to the other, depending on the jurisdictions, but also depending on the liabilities, on the nature of the beneficiaries of the pensions, right? The second big layer is obviously the board, right? The board of trustee. Sometimes there are many boards in kind of in accumulating into one supervisory board on top of that. And the question is to have really the right dynamic there, right? Obviously, then you have another layer, which is an investment committee. I've seen so many, I mean, how a well-functioning, with a very good dynamic investment committee can perform is just amazing when you compare to, I would say, more dysfunctional investment committee that can happen sometimes because of kind of misalignments between actually the different boards, investment committee, and the different process in place, right? And one thing that I would like here to say, and I think it's really the point of the whole presentation, is that it does not boil down only on having a proper governance of the board and a proper governance of the investment committee, but also it goes down to the next step, which is more an investment office related matter, which is on the whole strategic asset allocation. Because when you think about it, a lot of the large pension funds, specifically the Canadians or some Singaporeans, but also some in the US or in Europe, have gone into direct investment. And as soon, we have seen before also some real estate, as soon as you go into direct real estate, direct infrastructure, direct portfolio companies and private equity, you enter into a new world where suddenly you come up in your asset allocation where you have to be and to govern those portfolio companies and this related owned assets, right? In the case of sovereign wealth funds, for example, which are very similar, which are different from pension funds, but which are still very similar to pensions. You have a lot of sovereign wealth funds that own basically state-owned companies on top of their investments, right? And the big question for them is not only to manage the board per se in the investment office, but it's also to be able to manage all the boards of the different investments behind it, including all the state-owned enterprise or the direct portfolio companies which are into the portfolio. So, therefore it's very, very important to have this kind of alignment, right, all the time, at all time. And as soon as you think about that, there is the question of the strategic asset allocation. And as soon as you think about that, there is this concept that the impact of governance is very different from one asset class to the other. And it's not only about, when you think about the governance of a private equity investment, even if it's a fund, right, is very, very different than the governance of a public listed equity when you kind of own it, right? And therefore you have to kind of engage and have different form of engagement around those, right? And that's what we're trying to kind of address and to think, well, there are places where you're really sure of the governance and the form of engagement that you want. Then there will be asset classes on which it will be much easier to kind of bring that governance impact into your portfolio, right? And therefore, you will be able to select much more, not only those asset classes, but as is shown here in this slide, I would say governance-based, almost investable opportunities, right? And thanks to such a framework, the whole point on that, and that's the big, my experience that I want to share is that as soon as you have all these elements that we just stated above, there you are able to run through in a whole aligned and collective, effective decision-making based, right, through very complex topics that usually you have as a pension. We've been thinking about what are the big topics which are on the pension for 2023. We have discussed it in the panels before, but inflation, the problem of inflation, and how do you manage that from both your asset and your liability? How do you manage your liquidity and your cash flow planning in order to avoid real debacles that you can see when things inverse very quickly? How do you do to be really smart, for example, on the fixed income, right? When you can lock in easily now returns, which was not the case before, right? Are you going still to go for market opportunities, and how are you going to do that? How do you address the longevity risk today? I mean, it's very complicated. All these tables are constantly and very, very much changing as well there. And in a certain sense, you have somehow to change from a sort of 60-40 portfolio type of mentality. And so my point with that is that I want to say that these topics are obviously extremely critical and extremely complicated to take on overall and for a pension fund. But if you have the right governance at the board, at the investment committee, at the investment office level, and underneath your basically governance-led strategic asset allocation, you're in a much better place to be able to address those topics on a consistent and aligned way, and not in a kind of misaligned way, right? What we have seen when we look a bit at governance and what is this, right, is we live now in a world of winners and losers more and more. The disruption, when disruption comes from different type of sorts, those actually who are better governed, those organizations who are better governed will be actually more agile and more resilient, and therefore much more successful. So it's exactly the ones you want to kind of target with that. Same thing when it comes to different stylized facts you can get from the private markets. You can see that this governance is actually a key differentiator across all the risk factors, should it be the country risk factor, the equity risk factor, the credit risk factor, interest rate factor, the term spreads, etc. And therefore, it needs to kind of be put into an overall framework that makes sense, right? For that, in the pensions that I work with now, is that we have defined a way to address those governance guiding principles for a pension into 4 important pillars, right? One is to kind of think about the pillar 1, which is really the whole, the people, the quality, the diversity, the focus and the dedication around that. So basically the whole culture and the values around what we do, right? The second thing is to be clear on the whole information across our architecture, across the whole board of the board, the investment committee, the investment office, to have very clear structured process that kind of measure the governance impact on the different asset classes, right? And on the different sub-asset classes, and from a bottom-up and from a top-down part. And of course, to make sure that all of those dynamics are kind of aligned for effective decision-making. It looks very simple, those pillar 4, but it's really a way to kind of be able to ensure this main thing of this alignment of governance, to ensure that effective decision making, right? So when you apply that, and I will finish off on that, when you apply that really on a portfolio, right? Not only on the organizational governance and the strategic asset allocation, but what it means when it comes to investment. The question is really that you think, okay, good and bad governance are actually a driving force of the risk return of your portfolio, right? And you can exploit it bottom up, meaning you can choose and select all the companies on the listed market, on the private markets that are basically the better governed one, right? Because in a certain sense, you will be, if you choose those, you will have better governed companies that will perform much better, and notably in disrupted world and difficult condition. But also you have this bottom up, but you have also this top down to think about, where you can see, well, I'm very clear on the governance I want to have and the governance that has an impact. So therefore, let's choose the asset classes for my portfolio on which I will have the impact that I want, right? And this impact differ really across asset class. So there is a lot of data play into this and to kind of think about this, but more or less you can define some stylized fact where you can see really that there are certain features of, let's say, the bottom 100 type of stocks that particularly well perform in downward markets, that gives a downward protection, for example, and other features of that sort. And when you combine that with an ESG asset allocation, that permits basically to do your top-down and bottom-up approach. So here we'll pause, and I'm happy to kind of have some question on those governance-led investments.
Thank you, Elizabeth. Thank you. Let's now welcome Mirko Cardinale. He is the head of investment strategy at USS Investment Manager, where he is responsible for the design of strategic asset allocation processes. Prior to that, he was head of asset allocation EMEA at Russell Investments. And prior to that, he was the head of strategic asset allocation and multi-asset fund manager Aviva Investors. He holds a PhD in finance from Imperial College, and he will be sharing thoughts on investment governance, the case of USS with us. The floor is yours, Mirko. Thank you.
Thank you very much, and thanks for inviting me. What I'll do is I'm hoping to share the slides now. I'll tell you a little bit about the work that we've done this year in terms of rethinking our investment governance at USS. So first of all, a little bit of background on what is USS. USS is the principal pension scheme for the higher education sector, so all the universities in the UK. They're basically where we cover a wide population, 400,000 members between actives and deferreds. We are one of the few open DB pension schemes in the UK. As you probably know, in the corporate sector, most of the DB schemes are closed, so they're really run for the old members, but new employees are not able to are usually enrolled into DC funds. We are actually not a pure DB scheme. We are a hybrid scheme, which again it's fairly innovative. There's not many examples of that in the UK or elsewhere. So in essence, we are a DB fund. Up until so we are a DB scheme up until a salary cap. So if employees earn for earnings up until the salary cap, which is currently set at £40,000 a year, then the contribution will go into the DB fund. For earnings above the salary cap, then the contribution are channeled into the DC funds. And within DC, there's a lifestyle profile, and when there's funds with different risk parameters. So the vast majority of the assets are in the DB fund. We're talking about just above £70 billion. So effectively, the largest, usually the stats, it depends on what point you measure, but I would say the largest pension fund in the UK. And there is the DC component is smaller, about 2 billion, but obviously growing at a pretty rapid pace. So we are, in terms of our investment governance, just picking up on some of the points from Elizabeth earlier, we have a dedicated subsidiary. So USS Investment Management is a fully owned, dedicated in-house fiduciary management organization. So we effectively we manage the assets of the DB and the DC section of the pension scheme. We don't have any other clients. We also act as advisors, so we can provide strategic advice to the scheme. We are very much part of the same organization, so therefore we think we have a unique perspective. We can provide advice, and we also manage the assets of the funds. So if we move to the next slide. So let me tell you how the investment governance framework used to work, and then how we've actually changed it last year. So our old framework was based on the notion of the reference portfolio. So the reference portfolio was essentially the articulation of risk and return objectives into a high-level asset allocation. So risk return objective implicitly were translated into a high-level asset allocation. That high-level asset allocation was ultimately approved by the investment committee and the board. In terms of governance, we have a board of trustees and an investment committee as a subset with some independent members as well. So it used to be very much a decision of the board of trustees and investment committee on the makeup of the reference portfolio, which then became effectively the benchmark for the in-house fiduciary manager. And this is, you can expect a multi-asset, high-level multi-asset portfolio with about 54% in equities and a bit of fixed income and a large allocation to index-linked gilts, because in the UK context, the index-linked gilts are the closest representation, the closest asset proxy of our liabilities. We have liabilities that are indexed to UK inflation, and inflation-linked bonds issued by the UK government are the closest proxy. So in essence, this was a high-level portfolio with an element of sort of liability protection and an element of sort of allocation to return-seeking assets, and it sort of meant to represent the risk-return preferences of the trustees. So that portfolio was very much embedded in the mandate. So the mandate from USS to the in-house fiduciary manager, and the objective of fiduciary manager was to outperform on a rolling 5-year basis by 55 basis points, while taking less risk than the reference portfolio. So taking less risk in terms of a measure as asset liability risk. So less asset liability risk than the benchmark, and achieving outperformance. That was effectively the mandate. Now, that seems intuitively easy and appealing, but our experience was that it is problematic and probably not optimal for an in-house fiduciary manager. So we've actually gone through a full review of the investment governance framework, which really started with pretty much one-to-one interviews with the board members and the investment committee members, and really understand if the framework was working from their perspective. And one of the feedback that we received was that they felt uncomfortable with owning an asset allocation decision, which in the end becomes the most important driver of returns for the fund, and felt, well, perhaps that decision should be left to the investment experts, and we should be focusing more on thinking about the risk-return parameters in the first place. So in other words, the risk of an arrangement like this one is that too much time is spent on judging the fiduciary manager on whether he's performed well versus his mandate, so whether it's outperformed the benchmark or not, but not enough time is spent thinking about whether the benchmark and the high-level asset allocation is right, is a good representation of risk-return characteristics in the first place. And that really was a strong feedback that we received. I guess the other feedback was that this arrangement is probably a reasonable one if it's very much an arm's length relationship. So if we were an outsourced CIO, we were an outside organization with many different clients, then that's a transparent arrangement. But it wasn't really very good in terms of maximizing the synergies between an in-house fiduciary manager and the internal client, because with a mandate like this, in essence, the incentive for the asset manager and in terms of deploying resources is really to focus on the outperformance rather than focusing on helping the client defining a good benchmark in the first place. So that's basically all of this consideration have led us to move to a different approach. And now the new approach is very much about focusing the time of the investment committee and the trustee board on thinking about the high-level parameters. So in other words, what we now want the investment committee and the trustee board to do is to set the perimeter, set what we call the key risk indicators and the high-level return objectives across a number of dimensions, and really explicitly incorporate complexity, because I think it's wishful thinking to actually think that you can embed a complex set of risk return requirements into a high-level simple portfolio and nothing else is needed. There are multiple objectives. We want portfolios that are resilient at time of stress, and we've seen how important it is during the LDI crisis this year. We want to take into account our net zero ambition and our responsible investment commitments. We want to take into account the multifaceted view of risks, so from a tail risk perspective and more volatility. We want to take into account asset risk, but also funding risk. So there's a number of different perspectives that need to be considered. So our new approach is basically in a governance setup where the investment committee and the trustee board define parameters. They don't define an asset allocation. They don't translate the parameters. They basically give the asset manager a set of requirements without translating those requirements into an investment solution or an asset allocation. And then those parameters are also used to judge whether the asset manager has done a good job or not. So effectively, we use a balanced scorecard. We look at performance across multiple dimensions. Then the job of the asset manager is, first of all, to translate those parameters into an appropriate asset allocation, and then to manage the assets relative to asset allocation and add some additional value on top of the strategic position. So in essence, this is basically what the new framework is about: replacement of the reference portfolio framework, new arrangement for investment risk management, and also a new way of looking at the achievement or the performance of the fiduciary manager. That is not just about looking at performance versus the benchmark. And these are the main advantages: better alignment, embracing complexity in terms of return and risk requirements, and also I think one of the things I mean, it's very important is that the asset manager with this requirement becomes more accountable for the wider funding goals. So one of the risks of the old framework is that everything was translated into an asset problem. So the liabilities were, yes, implicitly considered, but in the end, the asset manager was only managing the portfolio relative to an asset benchmark. Whereas here, with the new framework, there are explicitly some key risk indicators that are in relationship to the funding objectives and the funding position of the fund. So they're explicitly incorporated into the investment process. So this is what we call the golden thread. This is how the new framework really works. We start from a high-level articulation of risk. So what is our disposition towards liquidity risk, towards funding risk, etc. So a high-level statement in terms of our attitude towards different types of risk, converted into specific metrics that we call key risk indicators. They're obviously brought together with an asset liability management framework. And then ultimately, these key risk indicators are then become the parameters that the fiduciary manager need to satisfy. There are some are explicit constraints, some are slightly softer requirements, but they're all incorporated into the investment management agreement. And we need to satisfy all of the constraints when designing our asset allocation and managing the assets. And finally, I'll just touch about what's the decision-making framework within the fiduciary management organization. First of all, we provide investment advice. So we have our own model on capital markets assumptions. We do run stochastic analysis and scenarios. So we provide input and advice to the trustees and investment committee in terms of the high-level decisions and effectively the perimeters and the translating risk return requirement into some specific metrics. So that's really an advisory input. But we then, once all those metrics are defined, once the perimeter is defined, then our key input is about one of the biggest jobs for us is defining how those inputs are translated into a high-level asset allocation. We have a small committee, an asset allocation committee that I chair with the heads of the 5 functions within the fiduciary manager, small group, very tight, where we make the asset allocation decisions and we approve a design of a strategic allocation at a very high level. You can see the example here in terms of mix of growth assets, liability matching. We set some hedge ratios, so the proportion of a liability that needs to be hedged from the asset strategy, how much FX exposure we want. And then the actual implementation of that is delegated down. So my team, the investment strategy team, manages and rebalances the portfolio relative to ranges set around the strategic allocation. And then there are obviously mandates delegated down to the individual asset classes, fixed income, equities, and private markets. And obviously they have flexibility to run the assets within their mandates and ensure that everything then is consistent with the high-level strategy. Yeah, so I'll pause here. We're very happy to hear any questions.
Thank you, Mirko. We'll get back to questions after Jaap van Dam, who I would like to introduce now. Jaap is the Principal Director of Investment Strategy at PGGM. He is the Chairman of the Dutch Association of Investors for Sustainable Development. He is the co-chair of the Research Committee of ICPM. He holds a master's degree in finance from Erasmus University. And he's also an author. He has authored Achieving Investment Excellence with Professor Kodik and Professor Slager. And this is a practical guide for trustees of pension funds. And he's going to share his thoughts on reconciling ESG and real assets. So, Jaap, I saw you nodding when Mr. Karitinos was speaking because of the real estate sector, I would assume. So the floor is yours. Thank you.
Thank you very much, Ilias. It's a pleasure to be here today. I think I already heard a lot of things that sound very familiar. Also, definitely by Elizabeth on the governance side of pension funds. I think very important, and I think she very rightly said this is a combination of the formal setup, but also definitely of the culture and the effectiveness you achieve over the value chain. I prepared a small presentation as an introduction, so I'll share my screen right now, and I promise you, Ilias, it'll be no more than 15 minutes. So here we go. Let me see. Yes. Oh. I thought I was able to share my PowerPoint. Yes, here we go. Sorry for this. Can you see it?
Okay, we can see it.
All right. Wonderful, thank you. So, as you rightly said, reconciling ESG and real assets, challenges and opportunities at PGGM. I heard some earlier remarks that pension funds perhaps try to be as much as possible compliant to what the environment asks of them. I hope I can show you that there are also some funds that really try to have an impact when it comes to ESG and, for example, climate change. And I'll start because I think this is a very important aspect of this. If you look at PFZW and PGGM, I will explain a little later how they relate to each other. Then the key objective to realize is realizing a good pension, but in a livable world. So we think that pension is not only about money, but it's worth a lot more when the world that you pension into is a livable world, and that gives an impetus for being a responsible investor. So short agenda: who we are and how we invest. What we do mean by responsible investing and ESG and creating impact, etc., etc. Then I'll zoom in a little bit, as I was asked, on our real assets investments and how we operate there. I'll zoom in a little bit deeper on real estate and infrastructure, and then I'll give you some key takeaways. Well, I prepared a wonderful slide on who I am, but Ilias, I think you have already told the audience, everybody which is on here. Perhaps one thing about the book: there is actually a chapter in it which, in a very practical sense, tries to help investment committees to be very well organized and being a very effective part of the governance of a whole pension fund. So here we go to who we are and how we invest between PGGM and PFZW.
Yeah, can I interrupt you for a second? I don't follow the slides. I think probably you should press on, let's say, slide number 5, so we can see it as well.
No, okay. So let me see. We had the same problem in the last one, didn't we?
Exactly. Yes. Now we can see it. It's fine. Okay.
Oh, okay. No, okay. So you interrupted exactly at the right moment. Then I will not go to the entire screen anymore in order to be able to steer around. PFZW, Pensioenfonds voor Zorg en Welzijn, is the pension fund. It's the compulsory industry fund, second pillar for the Dutch healthcare sector. So everybody that works in the Dutch healthcare sector, except for doctors and medical specialists who have their own funds, are members of our funds. That means we have something like 2.4 million members, 80+% of them are female. Our assets under management are 250 billion euros. And I think I can agree that scale probably matters here. And I'll give you some examples of that later on. And our annual premium income is something like 7 billion, pension payments 4.6. So we're still growing, and it also gives room for and scope for risk taking. Then at PGGM, we are PFZW's delivery organization. So what we do is we manage all the investments on behalf of PFZW, and we do their pension administration and communication. All in all, we are something like 1,500 people, of whom 300 are involved actually in the investment value chain, and in a broader or a stricter sense have impact on the actual investment decision making that we do. And I think when it comes to ESG and sustainability, we have often been leading there in introducing standards and platforms which really help asset owners and asset managers and also investments to steer into the right direction when it comes to sustainability. So we were among the founding members of PRI, the UN organization, the global real estate sustainability benchmarks. We recently introduced the SDI AOP platform, the Sustainable Development Investments Asset Owner Platform, which helps you to select investments that will contribute to the SDGs, and there will definitely be more in the future. As for how we invest, we are something like 60-40 return generating, so equities and significant risk taking, and something like 40% oriented towards our liabilities. So they typically would be very high grade credits or governments, etc. And when it comes to private investments, which I'll zoom into, 25% right now is private, and we're aiming to grow to 30 over the next few years. If you look at the way that we invest, then on the private side, we have immensely grown our capabilities, and I think that pays out when it comes to trying to be a very sustainable investor. In the public markets, predominantly, we are quite passive, or we have factor strategies, and we have a passive unless strategy. So what do we mean by responsible investing? I think it's fair to say that over the past 5 years, we see very much shifting objectives when it comes to ESG, sustainability, and creation of impact. So ESG, I think by and large, is trying to manage outside in, so the risks and the return potential that stems from factors in the environment, in the social realm, and in the governance. So actually it's trying to enhance the outcome of your portfolios by taking care of these risks. Whereas creating impact is inside out. It's realizing the fact, and I think with 250 billion, you should really say that it's by recognizing the fact that the way we invest actually has an impact on the outcomes of the real world, and that we should take responsibility for that. And of course, helping the world to reach the Paris aligned objectives is typically, I would say, an example of inside-out risk management. And I wouldn't say that we totally concentrate on creating impact, but if you look at the direction of travel over the past years, definitely the look at creating impact is becoming much stronger and is well equilibrated with the outside-in perspective. So typically we would call that double materiality, outside in and inside out combined. So how do we apply that on the real assets? So in this sheet, I have an overview of everything that we do in the private assets markets. As I said, something like 25% of the portfolio right now. And the 5 important components of our private market investments are private real estate, private equity, infrastructure, credit risk sharing, and insurance linked. And I think out of these 2, the private real estate and the infrastructure are the real assets components. So I'll zoom a little in onto them. And I hope that you're able to read this from your screen, but you see that the assets under management in private real estate is something like 22 billion. We have a team of 20 full-time equivalents, and the target allocation in our portfolio is a little more than 6%. We concentrate on core investments with a focus on joint ventures and club deals, and I'll tell you a little more about that later on. On the infrastructure team, we have 45 full-time equivalent people. We invest 40 billion, and this is aimed to be 5% of our portfolio. And here we have a direct investment style, we buy and hold. And this direct also makes it possible to have a lot of influence on what's happening in the infrastructure investments. So moving on a little to real estate, and concentrating a little on climate risk here. When we look at climate risk and how to tackle it, we look at transition risk. So what risk is emerging by transition to low carbon economies? On fiscal risk, of course, which risks are driven by physical impact of a changing climate? Of course, the flooding risk, heat stress risk, all those kinds of risks. And of course, in real estate, the asset level characteristics, the characteristics of the individual investments are very important when managing the portfolios. And we have a very clear picture of these risks on the asset level. And what can you do on the road to net zero in the real estate realm to make sure that you're on a net zero carbon pathway? So you typically start out, if you think about the investment in a building, of course, with the consumption of energy that you see at the moment that you acquire it. So what can you do then? You can apply operational changes, for example, make sure that the operator of the building is more efficiently using energy. You can enhance energy efficiency. You can do a deep retrofit, so you can change a brown building into a green building. You can make sure that the sources of energy you use are being decarbonized. So, for example, from carbon to wind and or solar. You can do on-site renewable energy generation. And if you make sure that all these steps are happening, you will seriously reduce the footprint of the building and thereby contribute to moving to net zero in the real estate. What is a bit disappointing perhaps is that there will be remaining consumption. Typically, new buildings can be extremely energy efficient and perhaps even energy positive, but typically when you look at the world total amount of real estate, only 1% per annum will be replaced by new buildings. So this is a slow process. So if you want to do away with the remaining consumption, then you probably have to do carbon offsetting or things like that. Not sure whether that's the path that we should go. A couple of examples here. A deep retrofit we did with the Senator House in London. And there you actually turn a brown building into a very green building. So that's a very good step. On-site renewable energy generation in the portfolio, for example, a large apartment building in Amsterdam is actually totally fitted with solar panels and therefore generates a lot of its own energy. The other example you see there is a facility in Tokyo, and you can clearly see the solar panels on top. So there you can really enhance the energy profile of the building. And what we do is not only concentrated on energy, but also on other SDGs such as good health and well-being, and sustainable cities and communities. And in the right of this picture, you see that we own a nursing home in the Netherlands, which is specially built for senior living and tries to create happy tenants and is attractive for healthcare workers. So we have a couple of SDGs that we're really moving towards. When it comes to steering the portfolio in the right direction, what we want is that the buildings that we partially own, or the funds we partially own, participate in GRESB, and that makes it possible to set a baseline and to monitor the energy and carbon emissions over time. So here you see how important it is to have standards. We want the managers to get a science-based Paris-aligned reduction target, so subscribe to the science-based Paris-aligned movement. And we annually assess the portfolio to see whether we are actually moving in the right direction. And here comes the governance into place. Typically, we will own a significant part of the funds that we invest in. That may range from, I would say, roughly 10 to 40%. That means that we have significant influence in the governance of the funds. And that means that typically the management will listen to us. And there even have been cases where we have replaced the management. So understanding what you're talking about and making sure that's happening is a very strong combination to get things done. Very shortly into infrastructure. As said, we have a direct investment strategy there in 4 sector clusters: energy, utilities, transportation, social and public-private partnerships, and digital infrastructure. We do no funds, so everything is direct. And what we see there also, it's important to have a sizable shareholding to obtain the appropriate governance. We always have a board seat there. The GRESB 2020 2 scoring was very high, as you can see, and 4 stars. So we actually have strong impact there measured by GRESB. And also here we are very actively in dialogue with portfolio companies on implementation of Paris-aligned targets. And it's important that these plans are science-based and approved over time. So again, here a movement towards Paris alignment in the investments that we have. And here I have a couple of examples. I want to come to my key takeaways. I think both real assets, both real estate and infrastructure, are great assets for creating real impact, because you're so close to the real world, to the real economy, and both sectors have a very large footprint, so you can actually achieve something there. As you probably have heard, that the ESG and impact creation are fully integrated in PGGM's approach to managing real assets. So it's not something which stands apart from the risk return management. No, it's fully integrated. Setting standards is very important, so that we are talking the same language, and we hope to share that language always with all the asset owners and asset managers, etc., in the world. Very important, I would say, is that the impact creation goal is not concessionary, so we are not prepared to give up returns for additional impact or ESG. We think that if you do it well, it can be both, and even the creation of impact can be return enhancing. I think we can show that very well in the real estate. For example, the retrofitting of buildings typically is contributing to the financial outcomes of the buildings also. So you have to know what you do. You have to have your influence, but it can be a positive sum game here. And how do we do that? We think deep knowledge and size here again might be a factor. Having sizable shareholdings and board seats are very important tools to realize this impact. This is what I wanted to share with you, and I want to thank you for listening to me, and I will now return to the screen.
Thank you, Gab. As we need to be done in 6 minutes, we have 3 questions, which I don't know how we're going to answer in that time frame, but let's try. First one to Mirko. Mirko, in terms of reporting standards and reporting the performance of the strategy, the question is, do you report risk-adjusted performance metrics like alpha, and may possibly comment on factors that you use to estimate it? You should unmute. Sorry.
Sorry, we report a number of metrics. So performance, both with and without risk adjustment, and we use different risk metrics. So more like tail risk and also risk related to liabilities. We also look at when we look at the performance of our asset allocation. We look at the performance of the benchmarks, excluding any alpha relative to benchmarks, and we compare that to in a new framework to an alternative asset allocation that we could have chosen that would have been compatible with the perimeter defined by the IC. So we have a set of comparators. So we look at the performance of our asset allocation relative to the alternatives, and then we look at the sort of the alpha side, so performance of mandates versus benchmark as a separate component, but with and without risk adjustment. Thank you,
Mirko. A question to Elizabeth. The question comes and says that you have substantial experience from CalPERS. In what way does it differ from big occupational pensions in Europe in terms of strategies and governance?
CalPERS has a very good governance in the sense that CalPERS is a conglomerate of many different pension funds. I mean, there is more than 1,000 pension funds who are all put together and where the assets are pooled, right? And so you have a board and an investment committee and a whole investment office that oversee this overall asset pool, right? This is one structure that is similar to other ones. I would say that I had in my career other experience. When I was the CIO of ABB, we had more than 100 pension plans across the world, right? And all of them have their own board of trustee, their own investment committee, right? And then you have so you have governance-wise a completely different structure, and you need to have a governance which is unique in particular to each of these different pension plans, and to have them all aligned together in the same culture, in the same values, and in the same I would say governance effectiveness, right? So it's
understood. Okay, and the last one to Jaap. Jaap, 2 minutes for the answer. I'm telling you. So it reads: in Canada, pensions are building infrastructure themselves. They benefited from the previous period of low interest rates, but now the situation is changing. And do you see that this is the way forward to other countries too?
Of course, we are looking very, very carefully at the Canadian way of working. I think so. The Canadians, to a certain extent, have really become entrepreneurs on their own. And this is also a Dutch law construct, I would say. We can be entrepreneurial investors, but we cannot be entrepreneurs. So we may be moving in that direction, but I think we will never arrive at where they are. Is that less than 2 minutes?
Yes, sure. So Elizabeth, Mirko, and Jaap, thank you very much for your time. George, back to you.